Yeah. Now let's look at the valuation part, which is actually the heart of any CFA's work, because one of the major things as a financial analyst you would be doing is valuing an equity, valuing a bond, valuing a derivative, valuing any kind of instrument, and based on that creating portfolio. That's a typical job profile of majority of the financial analysts. So from that standpoint, in the inside the equity, let's look at the valuation aspect, where we are just introducing to the concept of valuation in level 1, but as we move along we would be in the next level. There is a lot of calculation aspects around the valuations of the equity securities. So whenever we use the word in this valuation, we always use a very common word called overvalued versus undervalued. See, in most of the cases, there is a market price for every asset which we think of in the world. There is a market price, and there is a price which we perceive or which we feel is appropriate for that particular asset. Probably for an air conditioner, there is a market price, and at the same time, based on the features or based on something, we create our own assessment of a price. So our own assessment is always called as the intrinsic value of the asset. So at any point in time, we will compare the intrinsic value of the asset, which is our assessment price of the asset, versus the market price. So wherever we are seeing that the market price is lesser than our assessment price or the intrinsic value, we say that that particular security is undervalued, because our assessment is, oh, we are saying that even this much price is okay for it, but in the market it is available for much cheaper than that. So we may say that that particular asset is undervalued, and probably we can go for a buy decision on that particular asset. Whereas whenever we are talking about the market price greater than the intrinsic value, then we are calling it as overpriced and better not buy or probably sell off the asset. So that is where we talked about, we use the word called mispricing. So any valuation we are trying to do, there are multiple ways. Probably it could be out of our perception, or it could be a standardized way of, or it could be some formula based way of deciding your value. So there are hundreds of methods which can be used to decide the value of a security, but the whole intention is to understand which of the securities are mispriced, means our intrinsic value different from the market value. And so typically we have to see that today that security should be mispriced. Only then I will get into a misprice, means difference between our intrinsic value and the market value. So between these two, today if there is a kind of a difference, we will think of getting into a buy or a sell decision with an intention to bridge the gap. The prime intention is, okay, today this is our intrinsic value and this is the market price. So market price is cheaper. So what will we do? We get into a buy decision. Undervalued, so we get into a buy decision. So because of a lot of people like us thinking like this, there is a huge buy decision that is happening, which will actually increase the price. So after some period, it may so happen that the intrinsic value meets more or less the market value. That gap actually gets reduced. That is the prime intention of valuation, and then doing your decision making of buy or sell based on the valuation. Right? So it could so happen, if there is a lot of demand for a security, probably the top 50 equity securities, or top 100 equity securities listed on BSE or NSE, there will be a lot of volume which is traded on them. So those kind of securities, it's very difficult to find them undervalued or overvalued for a longer period, because people will quickly take their buy sell decisions and try to avoid that gap to a large extent. Whereas other securities, which are very small in size and all, you find that there will be a lot of mispricings available on those securities. So if you start doing your in-depth research on those small securities, which probably you may think of getting a very good advantage investing in those kind of securities, because most of the analysts neglect those small securities. So there is a chance of finding a lot of a gap between the intrinsic value and the market value for those securities. Then whenever we talk about equity valuation models, there are three major categories to focus on. Probably we can categorize them as DCF models, discounted cash flow models. So the concept of that we have dealt to some extent in quant, where we have used the concepts like NPV and IRR, and even in case of capital budgeting, where again we have used a discounted cash flow model to evaluate a capital project. So DCF is a very general kind of class of models which are used even for valuing your equity securities also. Apart from that, you have multiplier based models or multiple based models. So we use some kind of ratios like P by E ratio, P by price to book value ratio. We have seen some of the valuation ratios as a part of financial statement analysis chapter in FRA. So in that we were using some kind of multi-valuation ratios which were falling into these categories, and there we have also said that if those numbers are very high, then it is treated as overvalued, otherwise it is undervalued. So that's the second category of model. And the third one we are talking of asset-based valuation. So assets, I'm just finding out the value of the various assets the company is having, the machines, the inventories, the investments, various assets which the company is having, finding out the market values of each of the assets, and then doing a kind of and removing the liabilities to arrive at what is the final value of that particular company. So looking at these, the DCF, as the word itself is saying, you are, if you remember the way we have done the NPV or IRR analysis, we are talking about the present value of the future cash flows. And in an equity investment, what are the future cash flows? Today I invest, the only thing I get is the dividend. Let's say I buy a share of a company, the only thing I get is the dividend, and probably if I sell off the share, the capital appreciation. One of these or two of these are the maximum amounts in the future I'm going to get out of the investment in this particular share. So that is what we are talking about, discounting these to the present value. So forecast the dividend or forecast the share price after a couple of years and discount them to the present value, and based on that find out the intrinsic value of the share. Or sometimes if the dividend patterns of the company are ad hoc, we can also resort to the free cash flow based valuation models. We have defined the free cash flow in our cash flow chapter, the amount that is available with the company which is comfortable for distribution to the equity investors after all the payments and liabilities have been paid off. Whatever is the cash that is available with the company which can be distributed to the equity investors. So that is, so instead of dividend, people will estimate what could be the FCFE for the future, and use that FCFE and discount it to the present value to arrive at the intrinsic value of the firm. And when it comes to multiple based models, we have already discussed P by E, P by BV, P by sales, P by book value, or nowadays even people are using enterprise value by EBITDA. We'll talk about the enterprise value and all. So these are the various kind of formulas that are being used on a ratio comparison basis, right? So P by E, I'll compare company X P by E with company Y P by E. If P by E is higher, I may say that that company is overvalued compared to company B. So such kind of valuation models can be derived. And finally, the asset base. So we are simply looking at the total value of the assets minus the liabilities, and then find it out on a per share kind of a basis, which is what is an asset based valuation model, generally applied for not so performing, I mean for companies which don't have too much of a future, generally sick units, right, where the operations are not that great, which don't have too much of a future. If at all I want to value those kind of companies, generally asset based valuation models are used. For a company which is performing well, which has a lot of prospects and all, then discounted cash flow based models are more and more appropriate. That's how we can use the each of these models. So straightforward, whenever we talk about DCF model, you try to understand. I mean, the book talks about so many formulas and lot of other stuff. Simple thing for us is try to understand what dividends are getting received at what points in time. So the company plans to give a dividend of $3 after 1 year, $5 after 2 years, or probably $20 after 10 years. Doesn't matter. You take them as the future cash flows, find out their NPV by using your NPV formula of your calculators, and that's what will work out to be the intrinsic value of that particular. So all you have to understand is whether we are talking of dividends or capital appreciation or even free cash flows. Any of these, you just need to understand when each one of them are getting declared and how much. Once you know this, discount all of them to the present value, and that is what will be your DCF model, right? So we have already discussed on free cash flow to the equity. See, the definition wise, we have also said, when I wanted to talk about free cash flow to the firm, we said cash flow from operations minus the interest into 1 minus T, and we have also removed the capex, where which is the investment in the tangible assets. Whereas if I am talking about free cash flow to the equity, then we are adding back the interest. Sorry, here it is the interest plus. So we are subtracting back the interest, and we are also adding back the net borrowings for the period, which is like a capital repayment, principal repayment, or new principal taken. Even that is getting added as a part of the free cash flow. So once you have found out the cash flow from operation, you can compute the free cash flow to the equity, which indicates that the company has this much of free cash that is available in this year or period, which can be distributed in the form of a dividend. Whether the company distributes it or not, it's an internal decision. Can very well be taken as a decision, but it has a potential to distribute this much of a dividend. So typically, instead of dividend, I can estimate the free cash flows for each of the period, discount them to the present value, and say that that is the intrinsic value of the firm. So forget about the equations and all which are given as formulas. As long as you are able to compute, identify that these are the dividends, this is the time, just like your time value of money problems, right? You have to visualize all the valuation problems as time value of money problem. How much is coming at what point, or probably NPV IRR related DCF problem. You just need to visualize them, identify how much money is coming at what point in time, discount all of them to the present value using an appropriate rate of return. So, okay, in some cases, especially we get into, okay, typically speaking, what should be the present value? Let's say a company is saying that we will declare a dividend D every year. We'll declare a dividend D every year, or probably you are able to make out that the company has been declaring only D as a dividend for quite a few years. So we are expecting that for next few years also the company will declare a dividend of D only. So, and assume that the cost of equity for that company is some K, which is the return which every investor is expecting on the dividend. So the typical value, let's say D is the dividend that you are getting after 1 year. So the present value of it is this much. Again, you will get another dividend D after 2 years. So the present value is this much. Like that, assume that you will get dividend D forever, even after N or even 200 or 500 years also, infinite period. Possible? Because as long as you hold the stick, or if you are selling off the stock, let's say, if I say, okay, probably creating a small numerical, the company will be declaring a dividend of 30 rupees per share, right, in the next year, and probably for the next 2 years, a company will be expected to declare a dividend of 30 rupees per share for the next 2 years, and you are expecting that the share price will touch 1500 after 2 years, right? Share price is going to touch 1500 after 2 years. If your expectation is 15% per year, how much should you spend on that share today? What is the intrinsic value of the share today? Now in this, what are the cash flows that you will get in case you buy in this share? You are expecting 30 after 1 year. You are expecting 30 after 1 more year. And at the same time, you are expecting a 1500 when you sell off that share. So these are the total cash which you are expecting in each of the next 2 years. So you discount them to the present value. So probably you can you can find out the NPV of these two things, saying CF1 is 30, which is the cash flow you are going to get after 1 year, and CF2 is 1530, the cash which you are going to get after 2 years. At the interest rate of 15%, find out the NPV of your assignment, and whatever the NPV comes, you are very well saying that that is the intrinsic value of that particular investment. You are prepared to invest. So you will compare with the market value. That particular intrinsic value, you will compare with the market value. If the market value is lesser, you are taking a buy decision. Otherwise, you are going for a sell decision. This is the typical valuation process. But sometimes it is even seen that you will not sell off the share at the end of 2 years or something. Just like this example, I will sell off the share after 2 years expecting that the share price will touch 1500 after 2 years. But in most of the equity investments, they are assessed under the assumption that they are held up to infinite period. Because unless I sell it, because I assume that the company is there forever, unless I physically sell off the share, I keep getting the dividends from that company itself. So whenever we talk about the infinite period getting some kind of dividend, right? Using the mathematics behind it, using the geometric progression kind of a concept, the sum of all these things, wherever we see such a kind of scenario, every year the dividend is constant and forever, which is typically the case with preference shares. The dividend is constant forever. The sum of all these things put together will work out to D by K, which is nothing but a perpetuity formula which we have discussed in the quant part, right? D by Ke, which is the annuity forever, which is what is equal to perpetuity. And in some other cases, what we also talk of is this same dividend will grow. The same dividend is expected to grow at the rate of G every period. The dividend is expected to grow at the rate of G every year, which is what is the growth in the dividend. In the earlier example, I was talking about the constant dividend, which means the growth is zero. Whereas there could be an example where the dividend is growing every year at some rate G, right? At a constant rate G. So again, using the same mathematics, what typically comes out is if the dividend is growing at a constant rate G forever, the sum of all these things put together is D by Ke minus G. Or D is, the next period dividend which comes out as D into 1 plus G. This first one divided by Ke minus G. G is also in the denominator. Probably D1 is what it is called. D1 is the next period dividend, because we always talk about future cash flows. So not the past dividend. In some of the questions he may confuse you saying the last declared dividend was $3 and the dividend is going to grow at 10% every year. So you find out the dividend for the next period saying $3.3. Because $3 was the last dividend, the next dividend will grow at 10%, so it should become $3.3. So you take it as 3.3 by Ke minus G if at all you want to do the valuation of the entire. So Ke minus G is in the denominator. So if G is 0, which means no growth in the dividend, that is what will work out to our earlier formula D by K. Right? So these are the two common kind of formulas, especially if there is a infinite kind of a period coming in. So normally cash flows, if they are there, very straightforward kind of calculation, right? You find out all the future cash flows, discount all of them to the present value and try to find out the values. But wherever wherever you are finding the period is infinite, you make sure that you will look at it like from this period. So it is only from the period the cash flows are infinite for an infinite period and a constant growth. See, sometimes what could happen in some of the questions is he may say, okay, for the first 4 years the growth rate is 20%, but from the 5th year onwards the company is growing at the rate of 5%, the dividends are growing at the rate of 5% forever. So the infinite period is only from here to here. You should not consider the first 4 years as a part of the infinite period to apply your formula of D1 by Ke minus G. only from this period you have to apply the formula of KE minus G. So probably I'll give you one numerical that would become more easier in this case again. See, if at all I say the company has declared last declared a dividend of $3 a share, and for the next 4 years it is expected that the dividend will increase at 20% per year and 5% per year after that forever. So how much should I spend on this company? What is an appropriate price to be spent on the share of this company? So for this, what should I do? I have to understand what all cash flows are coming where. Okay, let me try finding it. Let me try writing them down. Okay. So what are the things here? What are the various cash flows in the first year from now? So probably if I say 1, 2, 3, 4, 5. So in the first year, what is the cash flow? The 0th year, the dividend was 3, which is the last paid. So in the next year, the dividend is going to increase by 20%. So I'm going to get that much dividend. Then again, the dividend is going to increase by another 20%. I may get 4.32 at the end of second year. Then again 1.2, so I'll get 5.184 at the end of third year. So if this numerical you can understand, you can solve all the valuation problems from this chapter as far as level 1 is concerned. So okay, so 4 years the dividend is growing at the rate of 20%, but from the 5th year onwards I'm saying that the dividend is growing at 5%. So at the end of 5th year I will get this increased by 5% only. Now from there, now if I see from this point, which means I shift 4 years later, my timeline is shifted after 4 years. From there, I am seeing infinite growth, infinite period, constant growth, right? So the present value of the future cash flows is nothing but D1 by KE minus G. This is not as of today, but this is as of this date. Because from that date only, everything looks like this. Looks like the next year dividend, because we said the formula D1 by KE minus G is nothing but the next year dividend divided by KE minus G, right? So from this, at the end of 4th year, end of 5th year looks like a next year dividend, right? So on this day, what is the value that I am going to get? For all 5th year to 1000th year, the sum of all of them is nothing but D1 by KE minus G. So D1 is this one by, let's assume G is 5%, right? So 0.05. So G is 0.05 or 5%. So let's assume KE to be some 10%. Let's assume the cost of equity is 10%. So all I am saying is this is my D1 by KE minus G, which means this is the value of 130, which is nothing but the present value of all these dividends, right? But to find the intrinsic value, I have to discount by 4 years, and even these 4 I have to discount by 1 year, 2 year, 3 year, 4 years, right? Because this is from 5th to infinite. This is from 5th year to infinite year total put together. This is the sum of 5th to infinite. But 1 to 4 I have individually separate. So each one of them I have to discount separately. So probably you can use your NPV, wherein CF1 could be this, CF2 could be this, CF3 could be this, CF4 could very well be the sum of these two. Right? Probably I can very well put up CF1, CF2, CF3, CF4. I can put it like this. Right? Now that my discounting rate is 10%, what I'll do, I'll find the NPV, assuming that the interest rate is 10%, and these are the four cash flows, which gives me 104.21. So at this moment, it is the intrinsic value for this kind of a share, which has given $3 as the dividend last year. Expected dividend growth is 20% for the next 4 years, and from there onwards 5% forever. So these are the steps you have to follow. So from where it is said that the dividend growth is forever, only up to that period you have to use the D1 by KE minus D, because D1 by KE minus D assumes that the dividends are growing at a constant rate forever. If there are two different rates, 20 and 5, so we should go to the period from where the infinite is actually starting and include only that period into your D1 by KE minus D formula. So you have to be comfortable with two aspects here. Finding out the present value as on this end of 4th year. Right? That is where probably in most of your answers, 130 also could be there in the answers to confuse your kids. So you have to make sure that that 130 is only from 5th year to infinite years, looked at from the end of 4th year, not looked at as of today, looked at from the end of 4th year, right? Because D1, which is the next year's dividend, which is growing at a constant rate, that needs to be looked at. Once this numerical is understood, then probably almost all calculations associated with equity valuations you can very comfortably do that. Fine. In this, there is another, the G, sometimes he gives in the exam directly. The constant growth rate forever, he gives directly in the question. But sometimes, if he does not give, we take it equivalent to what is called as the sustainable growth rate. What is this sustainable growth rate? I will compute the sustainable growth rate as return on equity multiplied by retained percentage. The retained earnings or retention rate. See, if let's say the company has paid profits of, paid 20% of the profit in the form of dividend, then 80% is what I call as retention rate, which is something getting back into the company. Multiply this by return on equity of the company, which can be nothing but, we had a DuPont formula also which was talking about return on equity, PAT by the equity net worth. So let's say if I am multiplying this by this, so 12% is what we generally call as the sustainable growth rate of the company. That is what we use for G as a part of our calculations. If at all he does not give G directly, that which is an infinite growth kind of a infinite growth rate. If he does not give that kind of a G, it can very well be arrived through this kind of a formula also. We'll take sustainable growth rate as an alias for G and use it as a part of our valuation calculations. Then See, whenever we are talking about dividend based models, right? What all the formulas we are saying, dividends have to be more or less following some pattern, right? We have said dividend growing at a constant rate, or dividends are constant. The first model which we have talked of is dividends are constant forever, D by KE. Then we said dividends are growing at a constant rate, right? Some G. Or probably dividends are growing for some years at a different rate, and probably after that at a constant rate, which means there is a constant rate scenario which we are discussing in all these examples. So unless we assume that the company historically has been paying dividends that are growing at a constant rate, then only for those firms only we can use this DCF kind of dividend discounting kind of a model. Otherwise, the dividend discounting model will become more and more inappropriate. Sometimes, if the okay for this period growing at some rate 20%, for some other period growing another at 10%, only from here if it is growing at 5% forever, still we can do it, right? For this you will find out the infinite d1 by ke minus g. So that you will come out as the present value here. Then each of these values separately you find out the take them as cash flows and find out your DCF. So that is what we call them as two-stage or three-stage model. You don't need to even remember them, because as long as you are fine with the concept, right? This is the period, these are the dividends. From whatever is the period, the dividends are going to be constant forever. You find their present value at that point in time. You have to shift yourself from now to that particular point in time from where the dividends are more and more constant, right? So you are shifting to that point in time, and you are using the formula of d1 by ke minus g at that point, right? And after that, each of these different growth rates in the dividend, you are finding out the NPV separately to calculate the final intrinsic value of the firm. So that is where, see, whenever we are seeing from an industry standpoint, if that particular industry or company is in a growth rate, is in a growth phase, we said that initially the growth is going to be very high. Growth is going to be very high means initial few years they may grow at 20%, 25% kind of stuff. But that cannot happen forever. Once the industry comes into a stable or a maturity phase, the growth will streamline. We have seen the industry life cycle kind of picture where initially the growth will be very high, after that stabled out. So after a few years, the growth will not be that significant. So initial few years they may grow at 20, 25%, but after a few years, which you may have to expect, what is that few years? 5 years, 10 years? But after that you are making it as more and more streamlined. So you in those kind of companies you may be talking about a two-stage growth or a three-stage growth. So your valuation also should go accordingly. So if you say tremendous growth period, moderate growth period, and a stable growth period, even those kind of things if you are bringing in, then you can talk about a three-stage model also, right? So these are the things. So probably a couple of numericals if you are practicing, it can actually give you all kinds of clarity. But the major models which we are talking of in as far as the discounting models are concerned is either a constant growth or probably different growth per different periods in time, wherein the constant growth forever comes only after a certain point in time. So these numericals, if the comfort is coming up, you can very well solve most of the questions as far as the DCF mechanisms are concerned. Then we are getting into the valuation using the multiples mechanism, where, see, P by E is the ratio which we said, or probably P by book value, which is nothing but market price divided by the EPS. Market price divided by the book value per share. Market price divided by sales per share. All these things, what they are saying is, okay, for every, let's say this is equal to 20 bucks. This is equal to 20, the multiplier. All it is saying is, for every 20 rupees you are spending on the share of the company is generating a profit of 1 rupee. Because I can very well write 20 as 20 by 1. I equate the numerator, I equate the denominator. For every 20 rupees which I spend on the company to buy the share of it in the market, the profit that it is generating internally is only 1 rupee, which means hardly 5% is the profit that it is generating. So if the P by E ratio keeps going up and up and up, it's an indication that for every 50 rupees I am spending, the company is generating 1 rupee profit, which means hardly 2% is the profit that the company is generating, which means that company shares are not that worth buying compared to some other company whose P by E ratio is 5. Which means for every 5 rupees which I am spending, the company is generating a profit of 1 rupee. So the higher the P by E ratio, we say that they are overvalued, and if the P by E ratio goes lesser and lesser, they go as undervalued kind of security. And now, if you typically see, what is the way we have calculated the price just now using a DCF method? We said K1, if the growth is constant, we said that this should be the price. If the growth is constant forever, we said that the price of it, the intrinsic value for it, should be equal to D1 by KE minus G. So when I say the price to earnings, I'm just dividing this by E. So even this is also, I'll divide even this by E. This is nothing but the dividend out of the profit, which is the profit payout ratio. Right, out of 100 rupees profit the company has declared, it is paying 20 in the form of dividend. Remaining 80 is going into retained earnings. So this 20% is the dividend payout ratio. So I can very well say D1 by or payout ratio by KE minus G. This is what is the P by E. So probably you may have to talk about, okay, in what scenarios the P by E will go up. If the if the payout ratio is going up, then the P by E is going up. If the KE is going up, then the P by E will come down. If the G is going up, then also the P by E will go up. So which of the following are the factors that will increase the P by E, whereas which of them will decrease the P by E? Those kind of calculations and analysis also forms a part of some of the questions. So you may have to be comfortable with this kind of an equation, either to solve the numerical or to come out with the analytical aspect using the multiples kind of an approach. So most common multiples, P by E, P by S, P by BV and P by cash flow. All of them, the scenario is the same. The higher the value, you can treat them as overvalued. The lesser the value. So they are all comparison kind of ratios with respect to competitors or with respect to industry average. The higher the value, you will say that they are overvalued. The lesser the values, we say they are undervalued and worth buying. That's a typical simpler aspect of valuation. Or what is the value? Then probably I may say, let's say for this company, the P by E is 20. But for all my competitors, the P by E is only 15. More or less around 15. So what will I say? This company is overvalued. So what should be the appropriate price for it? I'll go with, okay, what is that price which will make the P by E to be somewhere around 15 only? See, today, let's say the price of the company is, the share price of the company is 2000 rupees a share. and its profits today are 100. So which is the EPS. The EPS of the company is 100, which is taking the P by E to be 20. Whereas let's say for all competitors, the P by E is around 15. So what I'll say, the share price has to go to such an extent that even the P by E will also, for this company also goes to 15, which means the share price may have to fall to the extent of 15. So we are saying that it is overvalued. So probably better sell off your shares if you have, because as per you, the intrinsic value is nothing but 1500 using the multiples based valuation mechanism, right? Then we are also talking about another term called enterprise value. Enterprise value is more from a market standpoint, not from a balance sheet standpoint. It's purely from a market standpoint, which is nothing but the market value of the debt. So the total market value of preferred stock, market value of equity. Which is nothing but market value of equity is nothing but market capitalization, the total value of debt and the total value of preferred stock minus cash and short-term investments, because they are not a part of the value of the company. I mean, cash is nowhere a business, right? Cash is something in the pocket. It's not a part of the worth of the business. So I remove the cash and short-term investments which can be converted into cash, and this sum is called as the enterprise value of the company. So basically it's an extension of P by E. P by E, if I extend it, the extended version is called as price by EBITDA. I mean enterprise value by EBITDA, because the price is only of the equity investors, right? Share price. But if I take it to the entire company, it is called as enterprise value. The price is only the market value of equity component. But if I bring in the debt component also, the total investors, preferred share investors, the debt investors, all other investors of the company also, then we are calling it as enterprise value. Similarly, E is nothing but earnings per share, which is again the one that is going towards the equity investors. But EBITDA is includes even the money that goes to the debt investors also. Interest is still there in that group. Earnings before interest and tax. So that is where EV by EBITDA is looked at as slightly a bigger extension to P by E ratio, wherein not just the equity investors are looked at, but a company that we are looking at the combination of both equity as well as debt investors in the computation of the value of the company. Then moving on to the next model is purely based on valuing the various assets of the company. Generally, as I said, when there is not too much of future benefit that is generated out of the assets, and probably I want to just add up all the market values of each of the assets and remove the liabilities, I am using the asset based valuation model, because whenever a company is having only large amount of tangible assets, right? I mean, not too much of investments and various others, large number of tangible assets are there, and probably the expectations about what kind of benefits they are going to generate, if it can be estimated to a great deal, then we can get into the asset based valuation model. So typically looking at some of the advantages and disadvantages of the various models. The DCF models, they are very appropriate, right? Because we are talking of all future cash flows, discounting them. They are very tedious also, though we say easy to calculate, but estimation of what will be the dividend. See, calculation wise, it's not a big issue. But estimating what would be the dividend forever, what would be the right, what would be the growth in the dividend in each of the years, what would be the sustainable growth rate of the company, estimating all these things will be a very tedious exercise as a part of discounted cash flow model. But yeah, for most of the valuation, people prefer DCF itself because it's like a probably assessing the multiple based valuation model is more like, okay, I compare, oh, your price is more than my price, so let me increase my price. That's like a multiple based valuation model, right, wherein the valuation is purely done based on comparison with the others. Probably both of them may be overpriced, so that is not coming out through a multiple based valuation model. Whereas with the DCF community, the easiest thing is, I'm not bothered about the competitors or anything there. It's a real worth. So basically, even from a HR standpoint, if I have to give an example, primarily assessing only the real worth of the person and deciding his salary is like a DCF model. Comparing how much you have drawn in the last company and giving a 10% hike on the top of that is more like a relative based valuation model. So generally, people prefer relative based valuation models because they don't need to take a risk. But DCF models are the real worth. You assess the real worth of the person, and probably you may give 50 times more than his previous salary, or probably don't give anything more than his previous salary. All can be decided based on assessing the real worth, and DCF is more like that. But assessing the real worth is a very big difficulty. What kind of mechanisms you use to assess the worth of that person, right? So that is what we are saying. So I mean, instead of dividend, in most of the cases nowadays people are using the free cash flow itself, because dividend may or may not be stable. The company may give more dividend in 1 year, very less dividend in the other year. So because of the ad hocness in the declaration of the dividend, it is thought that instead of going ahead with the dividend based discounting model, it's better to go ahead with free cash flow based discounting models. And the infinite growth, that infinite growth formula which we have used, right, d1 by ke minus g, it's actually the other name for Gordon model. It has been actually designed by this person called Gordon. So it is actually called as a Gordon model. So where you find stability, because the growth rate should be constant, not too much of high growth, low growth kind of scenario. So Gordon model is directly applicable for an industry which is more stable, more matured, which can grow constantly, only no sudden rise, sudden fall kind of things associated with the companies. There we can use Gordon. Whereas for some other industries, we can think of using either the 2 stage or 3 stage, depending on at what stage in the life cycle of the industry they are currently in. But as I said, the disadvantage side, the inputs must be forecasted. Very difficult to estimate how much dividend the company can give in the next few years. Probably using the last 5 years or something, I may come out with some kind of ballpark figure. Yeah, last 5 years, this company is declaring a dividend, something like this. So in the next 5 years or 10 years, also I expect something to be in this pattern. But that's only an estimate from that standpoint, right? So it's very sensitive to the inputs which we are considering. What is the growth rate we have to consider, right? We said d1 by ke minus g. On what basis I decide the ke? On what basis I decide the g? G anyhow we said sustainable growth rate, right? On what basis this g is decided? So for all these limitations that are existing, though the dividend based or free cash flow based discounting model, the DCF models are very good to use. They have the limitations from these standpoint, which will limit the usage of these kind of models from a valuation standpoint. Then similarly, we have a price based multiple. As I said, they are very easy to compute and they are used very widely by the analyst, because comparisons only. Oh, this P by E is more than this P by E. So you can directly say this is overvalued, this is undervalued. Decisions are very, very quick. It does not depend on future values or anything. Current, this company P by E more than this company's P by E. So they are easily calculatable. Not too many values are required. I need just two values. The price which can vary every day. The earnings which I can take from the P&L statement of the company. So these two if I have, that's it. P by E can be computed for all of them and I can compare them across the companies or even across the time period. All kinds of comparisons can be done, even if it is EV by EBITDA also, enterprise value by EBITDA also, or P by S also, any of them, we can compute them quite comfortably because hardly very few values are required for their computation and they are all available either from the market or from the balance sheet and P&L statement of the company. But the biggest problem is when you say P by E, there is a good chance E can be negative. The profit of the company, if it has made a loss in a year, the E can very well be negative. So then there is no meaning to P by E. So ratio generally has a meaning only if the values are positive. So if the value is negative, literally from a mathematical standpoint also there is no meaning, which means it's very, very sensitive to the inputs. Right? If the E becomes negative, it gets completely haphazard. So it may or may not be applicable for all the firms. And that too if I am using across the world. Let's say I want to compare an Indian company with a US company. Right? The earnings of an Indian company could be much more compared to a US company because of probably inflation in India. The growth rate in the profits and all, they could be much, much more or probably stock market growth rate could be much, much more in India compared to that of a US because of the inflation being very high and the exchange rate getting depreciated, rupee getting depreciated because of various things. You may see that the comparison across the international firms on these P by E kind of a basis, comparisons can work only within an industry. I cannot even compare an IT company with a pharma company using this approach. Whereas if I am using a DCF model, there is no comparison at all. I am comparing with its own reality, market with its own reality. Whereas here I am comparing always between companies. And so what it says is, it's better that we use these ratios to compare only across the competitors, but not any two firms in the company, in the industry. So cyclical firms and all, they get very badly. You get into very odd kind of decisions when the comparisons are happening on those kind of basis. So wherever the negative P by E can go negative, price to book value can go negative, price to cash flow can go negative. Only probably price to sales may not go negative because I cannot sell negative money. Negative goods I cannot sell. So that's why sales is the only thing probably that may not go negative, but all the other things can very well go negative, which is again a big drawback associated with the multiple base. And as I said, though they are easy to compute, the biggest problem relies on, see, it's as good as saying I'm better than you, right? But both of them could be equally worse, or both of them could be equally good. So the multiples based approach does not say whether both of them are good or not. It's only from a relative. They are also called as relative valuation model. So I am always talking about in relative terms. This is better than this, but both of them could be worse also. This cannot be brought out by any relative valuation model, which is P by E, P by B. They are only comparison with respect to some other company's data and based on that making an assessment of the work. Whereas when it comes to DCF based models, we are not doing any kind of comparison with anything else. Everything is based on the internal, the expectations of the future about this company and discounting them to the present value to arrive at the intrinsic value of the firm. And when it comes to asset base, we are also talking about, it can give me the reality picture because I know what are all the assets the company is having and what is the market value of each of these assets. So, more and more tangible assets the company is having, large portion, let's say an airline company or some such kind of company, which have created a very huge tangible assets, some big capital infrastructure kind of companies where the tangible assets are very huge, and those kind of companies it could be much comfortable, but wherever the market values are difficult to obtain, right? Probably I may not, if I don't know what would be the market value for each of these assets, it becomes very difficult to value that particular equity. So it becomes more and more inaccurate if there are too much of intangible assets. Fully tangible whose values can easily be determinable, only for those kind of assets the asset based valuation models are more and more appropriate. And that too, if the inflation is very high, also called as a hyperinflationary environment. If the inflation in a country is very high, the asset prices keep changing every day, right? So in that case, doing a valuation of the equity using a asset based model is more and more complicated.